Good day, fellow deal makers. Welcome back to the Deal Scout. Hope you guys are having a great new year so far. We're in 2025, and we want to continue the conversations with deal makers, people who are buying and selling companies, people who are investing and growing, because we want to learn ourselves and our team over here, but also want to introduce you guys to different levels of deal making. And on that, I wanted to bring one of my friends on who's going to share a little bit about his story, but about the mindset of the deal and how to maintain wellness through transactions. That's a big thing that people who are selling companies tend to struggle with. So with that, let's introduce Mr. Shawn. Welcome to the Deal Scout Show.
Josh, it's an honor to be here. I'm a huge fan. I can't believe you've done over 2,000 episodes, and I'm really excited to have this as the start of 2025. So thank you for having me here.
Yeah, you're welcome, man. So, Shawn, let's just say we met for the first time in a coffee shop, and we tended to, dive into a conversation. I say, "Hey, man, who are you? What do you do?"
So I think most of your audience already knows mergers, acquisitions, and that, but I'll just give my little story just in case. So think of it this way. You go through life, you meet that special someone, two equals become one, right? You get married. Well, that's a merger. And now maybe you're walking the park hand in hand, and you go, oh my gosh, there's this little puppy. I want to bring this puppy into my house. If I bring this puppy to my house, it'll be a bigger house. There'll be so much more love. Okay, we're going to take this puppy. We're going to acquire this puppy through an acquisition and bring it into our house. Now the house is so much bigger. There's so much more love. But that puppy, well, it needs to go to the vet. It needs shots. It needs food. It needs all these things to become from this little puppy to this huge dog, right? So it needs capital, it needs growth capital for that. So all these transactions that happen in life, that's what I do all day long with companies, and then also secondaries, which are, if you hear in Silicon Valley, all these unicorn companies that are staying private forever. There's early investors, there's early employees, they're looking for some liquidity. I also work in that area as well. And we do a lot more, but basically anything transaction focused, that's what I do on a day-to-day basis.
Yeah, got it. And then the dog one day has puppies, and then those are spin-offs, right? And
Exactly, divestitures. There you
I
go.
like it. All
And
right,
then
so when you were going with this story, I was like, where's he going with this? You get married and then an acquisition. What kind of what kind of family dynamics are we talking there? But yeah, I like that picture. So when it comes to your kind of work, do you focus on a specific industry, niche, geographic? That was hard to say. Do you focus on those or more broad? What are your
it's more the
thoughts?
deal size itself. So geographic focus, not so much. I mean, I was working on a project in Canada last year. I was just in Brazil a few months ago for something for next year. I've been able to have the opportunity to work on deals around the world. So it's not so much geographic, it's not so much sector either, even though being here in Silicon Valley, it's more tech than anything else. For us, it's more deal size. And what I mean by that is, if it's less than 10 million, it really doesn't pencil out so much for an investment banker to be involved. Just if you think about the fees that the investment bank needs to run their process and versus the return for the seller, the return for the company that's looking to raise that capital. I mean, if, for example, say our minimum fee is 500,000. Let's just say that. If the transaction's a million, it just doesn't make sense.
Right.
Now, if it's 10 million, it does. If it's 50 million, fantastic. Right? So as these deals get bigger, our percentage of the deal gets smaller. So it makes more sense or it makes sense to get us involved pretty much with any deal that the numbers work out. So for us, we really like those deals north of 10 million transactions. I mean, north of 10 million. And then there's really no upper limit, but at each step of the way, there starts to be other banks that come in that have more of a focus in that area, that have more of those resources. So, you know, there's there's investment banks out there. They won't look at anything under 250 million, right? They just won't. It just doesn't pencil out for them. We're fine. We love that 30 to 100 million space. We love that whole range. So it really depends on that transaction size for us. So like I said, geographic not a constraint. Sector, not a constraint. It's just deal size that is where we focus. Now, secondaries, the deal size with that, it's a lot different just because of how the transactions are run. For your audience, I'm not sure how familiar they are with transactions and secondaries, But it's really just, okay, you got the seller, you got the buyer, let's match them up, and then the lawyers do a lot of the work. There's not as much public information because these are private companies, so you're going off a lot of articles online and news and that and kind of sentiment of the company. So there's not that process that's run like if you're selling a company or helping a company raise capital. So those transactions, they can be a lot smaller. They're a lot quicker. You know, kind of the target market for these companies. Um, so those are the areas that we play in. So more transaction size is the limiting thing than anything else. I mean, we got a great bench, great resources that we can pull from. Um, and I guess another limiting factor, and I'm sure we'll talk about it, is who we're working with. We do have that policy. We want to just work with people we like and trust. And I mean, Josh, I'm sure you've worked on deals as well, where you get that good client, you get that person you're working with, you'll go through hell for that person because you want the best for them. You want everything to work out. And then you've had those clients where it's just painful to get a text from them, painful to get a call from them, just painful because you know there's no pleasing them. They're
Yeah.
hiding stuff. You discover all these skeletons halfway through the process that you're like, wait a second, what's going on here? And it's just every time there's a message, you're thinking there's bad news. So let's carve those people out as well. So good people, anywhere in the world, sector not specific, but transaction size.
Yeah, greater than 10 million. Now, you mentioned the financial fee model, and you mentioned, minimum fee 500K, and you said as the deal size gets larger, the actual fees kind of decrease in percentage. Are you talking about the Lehman model, like the financial model?
Well, it really depends. I mean, sometimes we'll use the Lehman model, sometimes double Lehman, sometimes reverse Lehman, sometimes it will be a retainer with based on these milestones. And the 500K kind of that minimum fee, I just threw that out there for the example. I mean,
Okay.
it ranges quite a bit depending on the transaction. I mean, the way transactions are really structured is you think about it, okay, if we get this deal, we're happy. If we don't get this deal, we're okay as well. It
Mhm.
should be the fees based on, okay, how much hair is on the deal? What do we see as this transaction? How smooth is it going to go? Do we see red flags? Okay, if this is one of those deals where it could be very challenging, the fee should represent it. If it's
Mhm.
going to be this softball home run, you have the a group of potential acquirers all lined up that are knocking on your door, that it's just a handover, that fee structure should be different, right?
Mhm.
It should kind of represent that deal that you're working on. There's a lot of banks out there that I know that this is our fee structure. We're not flexible at all. This is what it is. I don't know if that's the best for the client. I prefer the let's find out about this deal. Let us do due diligence in advance of any engagements. Let us set up a mini data room with you. Let's us go over the financials. Let's us actually sit down and have a conversation, get to know each other for a good chunk of time in advance. And then, okay, now that we know all this stuff, here's what our engagement looks like. And there could be back and forth with that. You know what? This retainer is a little high. How about we lower that and increase the success? Hey, this retainer, how about we do milestone payments instead? Hey, do we get a discount if we do one chunk fee up front? Hey, this success here, can it be paid in the same way that we get paid? In meaning that if we get all cash and equity, you get paid equity and cash. Or if there's a seller's note, how does that look like for your compensation or an earnout? Or the flexibility, I believe, should be there because it represents the client or the engagement that you're working on. So that's how we go at it when we're talking to someone. We do a lot of due diligence in advance because I mean, these transactions, and Josh, you're talking 500 hours, a lot of these. You're talking six
Yeah.
to 9 months. You're looking at going, listen, my bandwidth only allows me to work on maybe three transactions a year, maybe four, depending. I need to make sure that I pick the right ones. I need to make sure there's a high conviction I'm going to close on this because it's so success based. I mean, when you're looking at a transaction where maybe 85, 90% of your compensation's off the success, you better go into it going, listen, I'm pretty confident we're going to get you what you want to close this deal. Because
Mhm.
if you're just trying to live off retainers, that's not going to cut it. If you're one of those shops that just collects retainers, I'm sorry, I don't see how you keep a brand that's alive when everyone in the background, word gets around. Wait, they're just collecting retainers. They're not closing. I mean, you want to be that group, at least in my mind, that goes out there and goes, listen, I think I can get what you want. You want to close? You want to close this year? Okay. Now let's make sure we're on the same page of you think the company's valued at this. Our market research, we think the company's valued in that range. You've had your conversations already with your wealth advisor, your tax planners, everything. You're confident that if we get in this range, you're going for it, and we feel with a high conviction we'll get you what you want. Like that's a great engagement, I feel. When both of you are able to have those conversations way in advance, both are on the same page, both have similar expectations, and now you're the Sherpa guiding that person through that transaction, getting them to the peak of Mount Everest, getting there or the Himalayas, and getting them all excited at the very top so that they can then take the next journey with their friends, family, whoever after.
Yeah. So the retainer plus success fee, the retainers to what, how do you for other, business brokers, M&A teams, investment bankers who are, having conversations with clients and they're going, all right, we charge a retainer plus a success fee. How do you typically describe what the retainer's for and why it's there? I think a lot of
Great
people
question.
struggle with that.
I think a lot do because, and you'll hear the potential client say something like, "Well, if you have so much confidence, you wouldn't charge a retainer."
Right.
You're like, "Well, we have confidence in our work, but how much confidence do we have in you pulling the trigger at the end and not at the last second going, wait, I don't see myself being the CEO anymore," or,
That
"Hey, you know
happens.
what? I was on the golf course and so told me my company should be worth this." And we're like, "Oh, who's your friend on the golf course? Like, does he know about the skeletons in the closet we discovered? Does he even know any of this stuff? No, probably not." But that retainer, we'll just tell him, listen, there's a few reasons we have the retainer. One, the main one is we want to make sure that you have some skin in the game, that you're committed to this transaction, that you're just not out there shopping because we're going to put in hundreds of hours and we want to make sure that you've thought about this in advance. And this little bit of skin in the game proves it to us. If you're not willing to put down a little bit for this huge, huge, huge reward, you you don't have this, you haven't thought this out. You haven't spent the time. You're not ready there. So
Yeah.
it's a vetting system for us, a screener to say, okay, does this person want to do this transaction? Do they want to move forward? And a lot of times they'll just think about, go, you know what? That retainer was enough to make me really think it's not the right time for me. Let me circle back in a year. You're like, great. That saved both of us hundreds of hours. So a lot of it is that screening. Then also we say, listen, it also keeps you engaged throughout the transaction because nothing will get us documents faster than when we send you the next invoice. And they might
Yeah.
laugh, but it's so true. It's
Yeah.
so true when you're saying, listen, we need these updated financials. Hey, we're going through the data room. You still haven't updated your cap table or your org chart or something.
Mhm.
And they're going, oh yeah, I'll get it to you. I'll get it to you. It keeps lagging. Next invoice comes in. What? Day after, all those documents magically appear in that data room. You're like, oh, okay. So it keeps them on track as well, and their team because that invoice goes to the boss. It's why is this not going faster, people? Why
Mhm.
is this why they say they're waiting for us? What's going on here? So it keeps everyone on track, and it also holds us accountable too.
Mhm.
Because when we're getting paid, listen, we can say this is we're it's not a passive process. It's we're active. If we're not showing you results and you're paying us, I mean that's egg on our face. Like we have to perform too. So it's keeping both of us engaged. It's a vetting process or a screener for it. And for us on our side, yes, we do use the retainer a little bit to keep the lights on. I mean, we have a research team, we have people that we pay hourly as well.
Mhm.
But that's not the main reason. The main reason is that vetting process and to make sure that they're engaged.
Yeah. I tend to find that when people pay, they pay attention. And it's hard to say you're going to pay me and it's good for you because it's going to benefit you better when you pay and when you invest in this. But I also find that the retainer is proof to me that you're motivated, like you shared, and that why should I take all the risk of you? as a deal maker who I make my living and provide for my family on successful deals, why do I carry all the risk and the burden that you're going to say and do what you're going to do, right?
Yeah.
Um, yeah, so I'm so with you. I'm so aligned with you, Sean. It's I think it's true, and I think it's good because at the end of the day, the analysts need to get paid no matter what, right? They're
Yeah.
getting paid on doing all this research and the assistants and the admin and it's a lot.
Yeah. It's surprising how many people out there have no idea the number of hours that go on in the background.
Yeah.
I mean, there's so, and when I tell people, listen, this whole process is going to be 500 to 800 hours from start to end, they're like, no, it's not. It'll be like, you're just going to send some emails out and then that's it. And you're like, are you kidding me?
Yeah. Yeah, you're just going to take some pictures and post it on, Facebook Marketplace and
Yeah.
this $100 million company is going to sell tomorrow. It
Yeah.
doesn't really work that way. Um, let's switch gears a little bit to secondaries. So private company, they built something great. They have founder shares, they have advisor shares, they have consultant shares. They built this great company, doing really well. But one of the early founders, kids needs braces or wants to go to an Ivy League school, and they'd like to cash out, right? Or at least cash some of their shares in. How does that work? How do you create the valuation of what those shares are actually worth? And how do you get someone to pay for it?
Great question. So, I mean, you don't necessarily depend on the company need to cash out, right?
Mhm.
There's a lot of investors out there right now that will give you a loan against those shares,
Cool.
right? They'll look at the last round valuation. A lot of this information you can find in different databases, PitchBook. There's online platforms that have marketplaces for these secondaries that people can kind of look at the last transactions. Granted, these places are not as active as, NASDAQ or New York Stock Exchange or that, where there's infinite number of deals happen, all the trades happen all the time. There might be one trade this last week, but it still says, okay, something happened.
Hmm.
But between that and then last round valuation, current talk, there's depend on the company. Sometimes they'll give you access if you're an investor and you sign the right documents to look at some financials and some insider information. And so going into it, you won't have all the details of public company, that's for sure. But you probably will have enough information to take a guess on, okay, is this a risk I'm willing to take? So that's a lot of the information for the valuation. Now going back to the liquidity, you can get a loan against your shares, depend on the company, depend on what you're looking for. Like if you're one of these big companies that everyone's talking about, I won't name names, but you probably want to get you might get 30% of the value for that loan, maybe 40%. So say you have 1 million, you might get 300,000. Now that person or group's going to charge a nice interest. They're going to look at it as, okay, I'm going to get my return when there's an exit here, plus this interest, plus maybe a little bit bonus, whatever it is that is written out, but it allows you to keep the upside. And a lot of people like that for these companies where they're like, listen, we're going to the moon. I don't want to sell these shares, but I literally have to because there's three of us in a studio in San Francisco. Like me and my wife, we're yelling all the time. On paper, I have like 5 million. I just want to get something where
Yeah,
we have some space. But this company, I think it's gonna keep 5x in every year. So I don't want to just sell it. Let's get a loan instead. So that's an option out
interesting.
there.
Yeah,
Now, some companies as well, they won't allow their employees to sell the shares. They don't want
really.
that swap. But some investors out there are okay with forward transactions. So it's that contract where, listen, I'll give you the money today. On paper, we'll sign a contract that when there is a liquidity event, I'll get the return. I mean, on those contracts, it's this person owns the shares, but the money is going to go to this other person today. A lot more risk. There's normally a bigger discount when someone does that, but that's an option out there. Now, just to straight out sell the shares, depend on the company. There's a lot of buyers out there for a lot of these companies. Why? Because they didn't have the resources, they didn't have the networks to get in these deals. They didn't
Hmm.
have the capabilities to get into these rounds. There's a lot of companies out there where it's I mean, you see these tier one VCs. We invested, so now our friends invest in the next round, and then their friends invest in the next round. And there's no room for these outsiders over here that are going, wait a second, I've been wanting to get in this company for last 2, 3 years, but because I'm not in that little inner circle, I don't have the capabilities, but I have cash. If there's any early employees, if there's anyone that's gonna sell any of their shares, let me know. I'm interested in buying. That price, it's all negotiable. The terms of it, you know, and I can go into that a little bit more detail, but what I'm saying is it might even be a premium because they're paying for access. They're
Hmm.
paying for something that they don't have.
Yeah.
Now, the terms on those shares are all different as well. Maybe it's just okay, here's straight cash for it, or maybe someone buys them, puts them in a special purpose vehicle, an SPV, and then another group, maybe they bought 20 million shares of this company from this one early employee, and now they take that 20 and they're gonna sell it off and make it a little fund where it's okay, you put 2 million in, you put 5 million, you put 10 million, and we're gonna charge you 2 and 20 for these shares. So they created a fund in SPV. And some of these companies, the biggest names out there, it's an SPV in an SPV
It's
to get
crazy.
access to them. It is nuts, this chain that happens.
Yeah.
And you just shake your head. You're like, wait a second, how many people are involved in it? Like, there's 7 bankers involved in it. What is going on here? Like, this is not happening. But yeah, that does happen for some of these more companies where there's a lot of interest and it's who you know to get in a fund with a SPV and an SPV. And I mean, those structures could be, this percentage for access, this percent for retain or management of it, and this percent for the carry. And I don't know how they do the math at the end of the day to see actually what they get, but they pencil it out.
Yeah. Yeah. Smarter people than me pencil that out and figure that out. When it comes to you mentioned liquidity, right? So we talk of, liquidity for the early employee, right? So investor comes in, I want to buy you know, your shares. Now I'm sitting on private stock. And what kind of options do I have for liquidity? Because I think that's a concern that many people have. So one, the company might go public, it might be acquired, right? But like, is that a how do you
It
think through that?
it's the same situation as that employee had, right?
Hmm.
They're looking at going, there's not much liquidity. I might have to sell it at a discount, or this is a high flying stock. I could sell it at a premium for access. Now, this other person has that asset, and
Hmm.
they're looking at it the same way. Okay, how do I put this in my portfolio? Where does this fit in my asset class? Where does this fit? Am I holding this on? Is this a vanity investment of mine? So I can just tell everyone I have some shares in this company. And trust me, there's a lot of people out there. You
Yeah.
ever you ever think it's kind of odd when you meet these, Midas touch VCs and it's like, yeah, I've invested in 10 unicorn companies. You're like, off math, how is that possible? Oh, because you bought the shares on the secondary market after you knew they were a year or two away from becoming a unicorn. Oh, okay, now I see, good market employee there. There's a lot of people out there that just want it in their portfolio to brag.
Hmm.
But going
Understand.
back to them, they're in that situation where, okay, how does it fit in their and remember, when it gets to that point for these companies, I mean, these aren't small investments normally. The people that are buying them are funds of funds, are family offices, are sovereign wealth funds, I mean, they're writing good sized checks for access to these companies.
Mm.
And there's background checks on everyone. It's not going to be that the person that got rich off Bitcoin that's a Scooby-Doo NFT, and you're like, who am I dealing with here? Like this, it's gonna be,
Yeah.
this is the fourth generation family office from over here, and everything checks out, and you're like, okay, because some of these companies they have to be careful who's on their cap table. They have to be very careful. They have to be careful who's in the SPVs on the cap table.
Yeah.
I mean, some of these companies out there, as just go in your just thinking of some of the names, think of the technology they're building. Think of, AI, all these. Everyone is checked off who's on these tables. And that's also why some of the times they can't sell these shares and why it goes into an SPV and an SPV. And that person that's buying it could be Cayman Island company that set up her family office over here. But there's a lot of due diligence.
Yeah. That's one of the benefits I believe of a good banking team and a group like yours is the ability to do due diligence, to look around corners that maybe someone doesn't have the tools or resources or the experience to do so. I promised this in the beginning of our conversation, and as we neared the end of our interview, I definitely want to talk about the mindset and mental wellness of someone who's buying or selling a company, right? So I built this for the last 40 years. It's been in my, like I built this from nothing, and now I've got to go sell this. What are some of the challenges that business owner may face in terms of mindset, mental wellness that you've seen?
Josh, I think this is the question that, I mean, this is the key because I've seen people just break down
Yeah.
during these transactions and they start second guessing life. There's so many ups and downs in these transactions. I mean, right before building out the data room, excitement, joy. All right, building out the data room, kind of having second thoughts. Oh, I could have done this better. I could have been doing this. I could, you're going out to market. Where's the feedback? Why aren't we getting these offers? It's only been 24 hours. Calm down.
Yeah.
We should have had, 100 LOIs at this point. Just relax. Negotiation of LI. Oh, this person's going to take my company that I've worked for, where all my friends are, that I've spent more time, that who knows, possibly they've gone through a divorce or two because of that company. And then going into, okay, we're about to sign the final documents, and wow, I'm not going to be that CEO anymore. I'm not going to be that. What am I going to do with my life? Yeah, I'm at that age, but there's more I can do. Or, you know what? I don't have those hobbies because I gave up everything for this business. I don't have, and you just have these conversations with them. And I mean, for my advice, while before the transaction is just to get to know them, go, listen, what do you have outside of this business right now? Do you have a hobby? Because if not, you better start some hobby.
Yeah.
Like
Yeah.
there needs to be something that will distract you from this transaction. It just can't be work. And also going into the transaction, have you talked to everyone in your inner circle about it? Because the last things we want is during due diligence, a significant other going, "Why aren't we on that vacation you promised me?" When it's no, you have to focus on this. Don't get distracted. Don't come into the meeting tomorrow, the management meeting, all moody because of an argument you had with someone today because everyone's not aligned. There's a whole emotional process that goes along with the transaction process. And having someone there to help and go, listen, this is what you should expect coming up. The LOIs, while we're negotiating them, remember, 3 months ago, we sat down and we wrote out, this is your idea exit this range. Now, when we go over these LOIs, keep that in mind when we're going through them. All right. Oh,
Mhm.
you notice how the LOIs match up with what you wanted? You're getting what you wanted. You're getting now. Remember that goal of being on that beach and having time with your grandkids? Remember that goal a few months ago. This will allow you to get to that goal because even before that, a year ago, you talked to your wealth advisor and you planned it out that this exit that we're talking about today will get you to where you want to go. And having these conversations along helps, but some people they'll just go into a transaction without any of these conversations, just going, I want to sell this business. And that's when you get the extreme ups and downs. It's no, no, no. And your advisor, whoever you're working with, honestly, this should be part of their job. Part of their job should be mentally preparing you way in advance, not just
Mhm.
going, hey, I want to work with you. So sign this engagement. Let's do this. No, 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 no. It's okay, before we sign this engagement, let's make sure the company's ready. Let's do our due diligence. Let's make sure that we're in that realm that the wealth advisor, tax advisor has told you to get to that exit. Okay, is your family strong enough? Are you emotionally strong enough for this transaction? Okay, if not, let's just pause. Let's work on that. Now we're good. Okay, now we're ready. Now let's do this transaction. Now let's go through it in advance, writing everything out. This is what you want. Here are the ups and downs to expect because this is what everyone goes through. And then, hey, here's the transition period. Here's your reward after for everything. And here's that beautiful vision that you've wanted. Now let's go. And that's the right path. That's the transaction that, goes smooth or the best case. And whoever you're working with, I mean, they should be working with you on that. And Josh, I'm sure you've seen I'm sure you've seen best cases and worst cases in this.
Yeah. And I was talking with one of my advisors just prior to this call, and his advice to me is find someone who's paved the path in front of you, and either hire them as an advisor, bring them on, figure out a way to follow the path of someone before you. And
Yeah.
I think that's what you're doing, and I'm really glad that you're doing that for people, Sean.
Well, I
Uh,
love that because my favorite quote of all time or saying is a wise man learns from his mistakes, a wiser man learns from the mistakes of others.
yeah.
And right there, I think that embodies that perfect. Get those people that you can learn from that have made the mistakes, and then excel past.
I like that. And a good salesman makes money on both of those, right? Yeah. Um, Sean, it's really great to have you here, man. And we'll be doing some more stuff in the near future. But for people who are listening in who want to start that conversation with you, maybe sell their company or initiate at least a conversation, where could they go to find out more about you?
If this is video, there's a QR code in the corner that goes right to my LinkedIn. If not, the easiest for me is just connect with me on LinkedIn at Shawn Flynn, SHAWN FLYNN, the investment banker there, or go to my website for my podcast, the Silicon Valley Podcast.com, and reach out to me there. But I like to have these conversations sooner the better. So feel free to reach out to me. Use me as a resource, a sounding block, and happy to have a conversation with Josh, any of your listeners.
Yeah. One more time, the name of your podcast show, because I want all my listeners and people who are my audience to go check it out. One more time, give it a shout out.
Really easy to remember. The Silicon Valley Podcast.
Perfect. Perfect. All right, fellow deal makers, as always, reach out to our guests. Say thanks for being on the show. If you have questions about, these kind of transactions, reach out to them and ask them. Ask them for help. Ask them for guidance, and maybe even help them, do a deal. So if you have a deal that you'd like to talk about here on the Deal Scout, head on over to thedealscout.com. We've got some really great things coming up in the future for you guys. And as always, hope you guys are having a great day, and we'll talk to you on the next episode. Cheers, everyone.